Good morning, all of you. Come back to the sessions now. Anyway, the last couple of sessions which I did, I covered credit risk management. Today, I expect to discuss about operational risk. Now, all other risk, we can just do some realistic calculations, but for operational risk, it's little difficult. So that is the most important thing with regard to the operational risk. So therefore, we have to see how we can get a good understanding about operational risk, and by managing operational risk, how we can get smooth service in the service organization. By doing that, how we can enhance the profitability of the organization. So that is the objective of studying operational risk management. So in order to give you a background with regard to the operational risk management, I have prepared 3 presentations where you can get a good idea. But I don't think that these 3 presentations will do everything, but this is only a guidance or guideline. What you need to do is you need to understand the basics, and you try your best to understand or derive something relevant to your organization. That is the most important thing, because organization to organization, the nitty-gritties of operational risk management differs. So therefore, what you need to understand is you should get the basics studied, and then afterwards you can see how you can apply these things into your organization's environment. That is what you need to do. So therefore, you need to very clearly get all these basics. And if you find any type of confusion or any type of, if you need any clarification, you can just ask for it then and there. And it would be very easy for you to get a real understanding. Right now, can you see the slide show on the screen?
Yes, sir.
Introductory note on operational risk. In actual terms, this introductory note is not a comprehensive type of thing which regards to operational risk, but you can get a basic understanding about operational risk by following this introductory note. Now, after following the slides, these key points to be understood. Now, the first thing, operational risk is defined in Basel II as the risk of loss resulting from inadequate or failed processes, people, and systems, or from external events. Now, these things are very much basic. So therefore, you should get a clear cut understanding with regard to operational risk, and you need to have a visualization of these things. Now, first of all, the risk of loss resulting from inadequate or failed processes. Now, then there you get the processes. Failed or inadequate processes will give an exposure of operational loss, operational risk. When operational risk event happens, invariably there will be a loss. That is what it says. So the first source of operational risk would be inadequate or failed processes. Now, you all know in an organization, or any type of an organization, should have to follow processes, their business operations. If they follow inadequate processes or failed processes, invariably they have to face with operational risk and resulting with losses. Right. So that is the first thing with regard to the operational risk. Inadequate or failed processes. Then you get the other factor, the people factor. Now, when you take in terms of people factor, there can be people issues. Now, you all know in an organization now, HR or the human resources are being considered as the most important asset we have. Or we call it human capital sometimes. But nevertheless, this human capital, if we have not really applied it in a proper manner, it will become a source of operational risk. People's activities or unwarranted activities sometimes would be there, some fraudulent activities or whatever. So there can be several things in that. So it's a very comprehensive type of things which you need to discuss. Right now, we have taken two things now. First, the inadequate or failed processes. Then the people's activities. We call it failed people's activities or irrelevant activities. So there you might get fraudulent activities or negligence or all those things come into people's activities. Then number three would be the systems. Inadequate or failed systems. Now there the systems actually, within those systems, you need to see the technology, the computer systems, cyberspace, all sort of things will come to this. If the system doesn't work well, then it will be really a source of operational risk. Now, these three, I just start from the inadequate or failed processes, then people's failed or inadequate people's activities, and systems, inadequate or failed systems, including all technological type of activities. That would really create operational risk. And the fourth one is very, very comprehensive, and it is there's no limitations for that thing. You can say external events. Whatever the external events happen, if it really have an impact on the organization, invariably there would be operational risk. So, only thing is the external events, we don't have any type of limitation for that. It can be anything. So therefore, this is a very vast area when you say external events. So therefore, in normal discussions, what we say is some weather issues, floods, then sometimes the tsunamis, or that type of things. Fires, wildfires, and all sort of things will come under these external events. Now, in this definition, that includes legal risk, but excludes strategic and reputational risk. Now, this is a very important point to note. When you talk with regard to operational risk, it really includes the legal risk. But the strategic risk and reputational risk would not come under operational risk. So, this is the most important thing which you need to understand at the beginning. In the Basel document, the operational risk is defined in this manner. That's what I have just given this definition at the beginning. Basel II document, operational risk is defined in this manner. There it says the legal risk can be taken as operational risk, the type of an operational risk, but strategic risk and reputational risk we have to consider separately. Now, this definition could be adopted by firms according to their needs. And the third thing is both qualitative and quantitative approaches are needed to effectively manage and measure operational risk. Because you need to think about qualitative and quantitative aspects of operational risk in order to manage it properly. Now, if you go to the last one, there you say operational risk is a key element in an enterprise risk management approach. Now, what do you mean by enterprise risk management? Enterprise risk management is the risk management all over the institution. That is what you call it. The enterprise is the whole institution. So all over the institution, that risk management has to be done. It is not restricted to any type of an area, any department or any type of business unit. It is to be managed. Length and breadth of the organization, it should be managed. That is why we call it enterprise risk management approach. Now you can just see these definitions. The old definition. In the past, there was a definition for operational risk. We need to see that, and we need to have some idea about it and some type of comment we need to make on that. Now, in the past, operational risk management had been defined in all risk that is not captured in market and credit risk management programs. So this was the earlier concept. Now, that concept was, now if you cannot capture anything under market risk or credit risk, all those things can be taken into operation. That was the old definition. But the Basel II definition of operational risk is as follows. Actually, now we have already discussed about it. Operational risk is defined as the risk of loss resulting from inadequate or failed processes, people, and systems, or from external events. This definition includes legal risk but excludes strategic and reputational risk. Now, this is this particular thing being extracted from the International Convergence of Capital Measurement and Capital Standards, revised framework of Bank for International Settlement. So this was the document this has been extracted from. Now, when you just put it into different points, the risk of loss caused by inadequate or failed processes, inadequate or failed people. Now, when you say failed or inadequate, that means sometimes it might be a failure in their integrity. So the frauds can happen in that manner. That's what I want to tell you, because even though we just put it in this manner, inadequate or failed people, people's failures can be, when you say inadequate people's activities, means inadequate means they are not adequately trained sometimes. They are not adequately, their integrity is not adequate. So such type of things means inadequate. So then the fraudulent acts also come in under that. Failed means, now if they worked in a negligent manner, that is a failure. If they have not managed anything properly, that is also a failure. Now those are the failed people's activities. So likewise, now anything coming under people's activities can be taken under this. Now, when you say inadequate or failed systems, that refers to different systems which are in operation in the organization. Inadequate or failed systems. Then you get the external events. Now, when we discuss the things in a comprehensive manner, this inadequate or failed systems, under the inadequate or failed systems, we discuss on technology also. Technology also come in under systems. Not only the technology, the cyber spaces, the IT, digital technologies, all sort of things can come under this. So therefore, our discussion would be very much comprehensive on this point. Then you get the external events also. There you get several events, and there's no limitation for these events. It can be anything. Right now, this is a small exercise, but anyway, now these things are, I think you should not take it as a burden, but this exercise is given for your better understanding of these things. Look at today's newspaper and identify 5 different events that meet the definition of operational risk. I think if you look at the newspaper, you can see several things which you can categorize under operational risk. So this is a, very fun type of an exercise. So you can do that and just take it that way, because don't take it as a burden, but in a very, very enjoyable manner, you can do that. So this is a small thing that you can do, and I think at the next event, at the next discussion, you can come up with these 5 events, each of you, right? So therefore, you can do that today after the class. You can do that and see what those things are. I mean, the newspapers. Now, these are the recent examples of operational risk in the headlines. And there was a fraud, high-level fraud done by Madoff. There's another person called Stanford. Then unauthorized trading by Society General and UBS. Society General is a international bank. UBS is also an international bank. Then insider trading, Raj Rajaratnam and Nomura, SAC Capital. Then technological failings, Knight Capital, Nasdaq, Facebook, IPO, anonymous cyber attacks, and all sort of things are coming under technological failings. Weather catastrophes, hurricanes, tsunamis, earthquakes, terrorist attacks, and so all those things are coming under catastrophes. Now, when I take this Basel II and Basel III, International Convergence of Capital Measurement and Capital Standards, a revised framework. Now, this is the name of that document. Now, this is published by the Bank for International Settlements in Europe in 2004. New risk rules for internationally active financial institutions that wish to continue to do business in Europe. The rules included enhanced requirements for management and capital measurement of market and trade risk, introduced a new capital requirement for operational risk, laid out new qualitative requirements for operational risk management. Now, under the Basel III, that happened. Now, this is a legal risk. This is with regard to legal risk. Legal risk includes, but is not limited to, exposure to fines, penalties, or punitive damages resulting from supervisory actions, as well as private settlements. Legal risk includes but is not limited to exposure to fines, penalties, or punitive damages resulting from supervisory actions, as well as private settlements. Now, all these things are coming under legal risk. Now, the exclusion is, this definition includes legal risk, but excludes strategic and reputational risk. Now, banks adopt the definition. Now, these are the different types of adjustments or adoptions by different banks. Operation risk is the risk of loss resulting from inadequate or failed process or systems, human factors, or external events. Now, this has been adopted by JP Morgan Chase and Company, that is a big bank. Then this definition was adopted by the Deutsche Bank. Operational risk is the potential for failure, including the legal component in relation to employees, contractual specifications and documentation, technology, infrastructure and disasters, external influences and customer relationships. Operational risk excludes business and reputational risk. Now, just look at these statements where you can see how the different banks have taken these things into consideration and adopted for their usage. That is what I want to tell you. Now, JP Morgan Chase is a highly reputed bank. Even the Deutsche Bank is also another reputed bank in the world. These reputed banks have taken their own way of operation risk definitions. And lastly, the operation risk is the risk of loss resulting from inadequate failed internal process, the same thing. But there can be small differences. The small differences would be there. Now, the last one is the Citibank's definition of operation risk. Operation risk is the risk of loss resulting from inadequate or failed internal processes, systems, or human factors, or from external events. It includes the reputation and franchise risk associated with business practices or market conduct in which city is involved. Now, these are the regulatory requirements with regard to operational risk. Now, the regulators need all the financial institutions coming under them. Should they need, their need is to, or their requirement is to, those institutions should identify operational risk, assessing the size of operational risk, monitoring and controlling these risks, mitigating things and mitigating operational risk, and calculating capital to protect from operational risk losses. Now, this is the normal task with regard to the regulatory requirements to be done by these banks or the financial institution. Now, the regulators need the banks and financial institutions coming under them to look at operational risk under the following headings. First of all, these organizations should identify operational risk. So that is the first thing. Then these identified risks to be assessed to see the quantity and the frequency of such type of operational risk. Then they need to monitor and control these operational risks. Then there should be a mitigating steps to be taken. But the final thing is, in order to protect from operational risk losses, these organizations should provide capital to absorb operational risk losses. So enough capital has to be assigned for that. So that is the first 15, and that is the most important thing. under regulatory requirements. Now, I have just put here some comments with regard to the Summer Olympics. In 2012, it happened in UK. Now, the Prime Minister has said these things, imperfections and things going wrong. One day we will tell our children and our grandchildren that when our time came, we did it right. So all these, the statements have a flavor on some events of operational risk. Now, causes of operational risk, people causes, the nervous athletes, opinionated officials, aggressive press, terrorist, disgruntled Londoners, security guards, confused volunteers, crazed fans, lost children, heads of state, visiting dignitaries, and the list goes on. So now the causes, people causes for operational risk with regard to Summer Olympics been taken as these. Nervous athletes can become causes of operational risk. Opinionated officials can become cause for operational risk. Aggressive press. Now, press is a real culprit in disseminating risk everywhere. Not only in Sri Lanka, every country it is happening. Then confused volunteers, lost children, heads of state, and the list goes on. And when you talk in terms of process and systems, the stadium building and preparations, ticket sales, transportation, opening ceremonies, closing ceremonies, Olympic village management, cleaning, feeding, running races. Nowadays, actually, I think the last Olympics conducted, and there, I think the most prominent risk was the COVID-19 thing. You remember, no? So you can go through that again and see how that operational risk been formed there. Now here in 2012, that type of epidemic was not there. But this time Olympics, we faced with that epidemic. So there the prominent risk was considered as the COVID-19 menace. Organizing matches, safety checks or parallel bars, awarding medals, playing anthems, global broadcasting, keeping that darned flame alight, and the list goes on. Then external events, London weather. So that is the external events coming under Summer Olympics operational risk. Hello. But in the in the Summer Olympics, the comment under external events is only 2 words: London weather. So you can see how that London weather could be a operational resource. Now, in the Basel document, operational risk events been given. These are the events, operation risk events. Internal fraud is one type of an event. External fraud is another event. Clients, production, business practices, the other one. Employment practice and workplace safety. Execution, delivery and process management. Damage to physical assets. Business disruption and system failure. Now, all these things are taken as, there are 7 altogether. 1, 2, 3, 4, 5, 6, 7. Now, 7 risk events, we call them. Now, under the Olympics, how these 7 events been applied? When you say internal fraud, Olympic badminton players disqualified for trying to lose. What is that? It's like match fixing type of thing. Now, can you just gather it what it is? Olympic badminton players disqualified for trying to lose. Now they try to lose. Maybe they go for some fixing type of a thing. Now, have you heard about this match fixing? No? Even in cricket, it happens. Match fixing. The same thing happened in Olympic. In 2012 Olympics, the badminton players tried that type of a thing. They tried to lose their game, and by doing that, they wanted to just favor some of the betting people, some gamblers. So that is what it means. Internal fraud is that. Then external fraud, London Olympics, fake tickets create honeypot for criminals. Fake tickets are also being issued. That's a fraud. Externally happened. Then clients, production, business practices, empty seats at Olympic venues prompt investigation. Most of the in venues you found empty seats. I think something wrong somewhere, because people were looking to even paying high, and they try to come into the Olympic Games, but you found later some empty seats also. Something went wrong. Then the employment practice and workplace safety, dispute between London Olympics and musicians union heats up. Now, musicians also coming under the Olympic, the whole Olympic village or whatever, and they become employees in that Olympic Games. But there was a dispute between London Olympics and musicians unions. Then execution, delivery and process management. National Athletic Board holds London Olympics ticket distribution a failure. Now that is an internal execution failure, a delivery and process management failure. So that can be taken under that. Damage to physical assets, Olympic security shortfall called absolute chaos. Business disruption system failure, London 2012 traffic jams and impact of games lanes. Now, all these things give some idea about operation risk events. Now, the second test or the test 2 is the risk management tool. Did they identify and assess, monitor and report and control and mitigate the risk? Management used a common model to identify and assess the impact of risk to their business. For each risk, the likelihood and consequences are identified. Management controls and the frequency of monitoring are confirmed and results reported. Now we can see these different loss events, operational risk events. Now I can read these things, but anyway, these things you need to follow again. Internal fraud, losses due to acts of a type intended to defraud, misappropriate property, or circumvent regulations, the law or company policy, excluding diversity, discrimination events which involves at least one internal party. Now, discrimination and all sort of things cannot come under fraud, but now they have critically said or categorically said the internal fraud. What is the meaning of internal fraud? They are which involves at least one internal party. Now, if internal party is not involved, it is not taken as internal fraud. At least one internal party should be there. Then only we can put it as internal fraud. But there should be a fraud also. Losses due to acts of a type intended to defraud. So intention should be there. Misappropriate property or circumvent regulations, the law or company policy, but excludes diversity, discrimination. So those things, events, which involves at least one internal party. So these things exclude, right? So you cannot really take as a fraud. Now, if some people discriminate against others, that is not taken as a fraud. That can be taken as another one. It's not a internal fraud type of an event. Now, when you take external fraud, same thing coming there. Losses due to acts of a type intended to defraud, misappropriate property, or circumvent the law by a third party. Now, that is the difference. Now, you can just see the difference between internal fraud and the external fraud. Then you get to another one, next one, third one, employment practices and workplace safety. Losses arising from acts inconsistent with employment, health or safety laws, or agreements from payment of personal injury claims, or from diversity discrimination events. Now that diversity discrimination events have come under that. Employment practices and workplace safety. I think it is really descriptive, so I think you can understand that losses arising from acts inconsistent with employment. So employees do something which are not in line with the code of conduct or that type of a thing, arising from acts inconsistent with employment. So they have not followed the correct policy or correct methodology. By doing that, they just cause some losses to the company. So that is what we mean by employment practices and workplace safety type of operational losses, operational risk. Health or safety laws or agreements from payment of personal injury claims. Now, workplace safety is a responsibility of the organization. Now, if some worker or an employee sued the organization against that not providing the workplace safety, then the organization has to pay for that. So that is also a type of a cause of operational risk. Workplace safety arrangements are not being taken into consideration. So that type of thing. Then the fourth one, clients, products and business practices. Losses arising from an unintentional or negligent failure to meet the professional obligation to specific clients, including fiduciary and suitability requirements, or from the nature or design of a product. So sometimes the products being designed with some quality issues. And even business practices are not really according to the normal or standard type of practices. So then the organization has to face with some issues, some losses been arising from that. Then damage to physical asset is a very easy thing. We can just see losses arising from loss or damage to physical assets from natural disaster or other events. Then business disruption and system failures. Losses arising from disruption of business or system failures. Now, this is the most common thing in most of the businesses, basically the banks. Their system failures are very much frequent most of the time. Then execution, delivery, and process management. Losses from failed transaction processing or process management, from relations with trade counterparties and vendors. Now, when we can compare operational risk with market and credit risk also, there are similarities, should be actively managed because failure to do so can result in a misstatement of an institution's risk profile and expose it to significant losses. So this is the similarity. Now, this is also another risk. So if you don't actively manage that, then that could really have big exposures, and the organization has to face with severe losses. Then differences, not directly taken in return for an expected reward. Now, normally when you go into credit risk or market risk, now credit risk is really the organizations exposed to credit risk because they try to do business. They try to award credit facilities. Now, when they grant credit facilities only, they exposed to credit risk. But when they grant credit facilities, their intention is to have a profit. So they should expect they expect a reward. To get that reward only, you need to face with that risk. But in operational risk, it is not the case. Even in market risk or credit risk, it is the case because you have taken that risk in order to have a return. But operational risk is not in that nature, because operational risk, I mean, if you get the burden of operational risk, you will not get rewarded anytime. So always you will get a loss. Always there's no profit from any operational risk. That is the difference. Exists in the natural course of corporate activity. So even if you don't do any business, there will be operational risk. I think this is, I don't know whether you got my point there. The point is, for any other risk, basically the credit and market risk, you have just assumed those risks in order to have your business. Now, what do you mean by having the business? Business is that the intention of your business is to earn profits. So then you are going for a reward. In order to get that reward, you have to assume that risk. But for operational risk, assuming operational risk will not give you any rewards. That is the difference. Now, when you say quantitative and qualitative approaches, for operational risk, the quantitative approach is Basel II requires capital to be held for operational risk. Now, when we say quantitative, the meaning is there should be a measurement device. Operational risk should have a measurement device. You should measure operational risk in quantitative terms. Now, the The main objective of measuring operational risk is to see how much capital to be assigned for that particular risk. For that, there have been several possible calculation methods. So basically, I think you have heard about it. Now, there's first thing is basic indicator approach. Then you have standardized approach, and then advanced measurement approach. Those are the three approaches given in the Basel II document. But nowadays, this quantitative measurements are done through only the standardized approach. This advanced measurement approach has not gone into that levels, but nowadays the banks or other organizations, they try their best to have a standardized approach for quantitative management, but they don't go for advanced measurement approach. Under qualitative, must also demonstrate that they are effectively managing their operational risk. Now, under section 736 of the Basel document, the committee believes that similar rigor should be applied to the management of operational risk as is done for the management of other significant banking risk. So that means no organization can neglect operational risk as something lower. So they should give the same prominence to operational risk. That is what it means. 737 said the bank should develop a framework for managing operational risk and evaluate the adequacy of capital given this framework. The framework should cover the bank's appetite and tolerance for operational risk as specified to the policies for managing this risk, including the extent and manner in which operational risk is transferred outside the bank. It should also include policies outlining the bank's approach. Now, all these things are coming under operational risk framework. We will have a comprehensive discussion on operational risk frameworks later. Now, these are the qualitative elements. Risk appetite. So, what is the meaning of risk appetite? Risk appetite is the amount of risk you like to take as an organization. That is what you call risk appetite. Because it is not the risk tolerance. Because appetite means you like to have that risk. But in terms of operational risk, I don't know whether any organization will have a risk appetite for operational risk because they don't need to take it. Because they don't get in reward for that. So therefore, someone can say the risk appetite can be zero for operational risk. So that's one argument, right? I don't know whether if you don't agree with me, tell me. In my opinion, for operational risk, you should not have any risk appetite. It should be zero because assuming operational risk will not give you anything. So therefore, in every respect, you have to manage operational risk. The policies must be written that outline the bank's approach to identifying, assessing, monitoring, and controlling operational risk. Tools. Now, the tools means the way you can have a framework to manage operational risk. Tools means how you do that management. The first thing is loss data collection programs. Then you have risk and control self-assessments, scenario analysis activities, key risk indicators, reporting. All these things are taken under tools. Loss data collection programs, risk and control self-assessments, scenario analysis activities, key risk indicators, and reporting. Now, for an organization, I think in all of your organizations, this loss data collection is done. Now, I like to get your ideas on these things, which for your organizations, are you doing this loss data collection programs? Is it in operation in your organizations? Loss data collection programs? Yes. What do you say? These loss data collection programs are available in your organizations? Because you need to have a practical approach for this. Otherwise, you can't manage operational risk. That is the most important thing to manage in an organization. Otherwise, what happens is you might really end up with so many failures later on. Yes, let me get your opinion on these things. How did you really engage with these loss data collection activities? Any activities have you, I mean, if anyone had that type of activities, just let me know. I mean, that should be there, but I don't know any organizations. If I remember correct, we started these things in 2008, like. So therefore, all of your organizations might have now. They should have a very active program to collect loss data, operation loss data, which gives you a certain idea about operation risk. There can be combinations also, operation risk together with market risk and operation risk together with credit risk. Now just look at this enterprise risk management framework. Right, just look at this diagram. Now ERM is what you call enterprise risk management. Now you can see in the circumference, market risk is there, liquidity risk is there, operation risk is there, credit risk is there, strategic risk is there. So this is the external cycle. Operation is also coming under external cycle. Liquidity, market, strategic, and credit. Then in the inner circle, you get geopolitical risk. Geopolitical risk. Then further inner circle, you get a reputational risk also. So enterprise risk management is in the core. So all these things to be done in order to get the enterprise risk management all over the organization. Now these are the drivers of operational risk management. Three main sources. Regulators, they drive the operational risk management because they need some regulatory reports, they need some regulatory action. Then senior management, be fully informed of the risks that face the firm, including operational risk exposures, avoid bad surprises, make strategic business decisions fully informed of the operational risk implications. Third parties, ratings agencies, investors, and research analysts. Now, normally these rating agencies and investors are very much particular about the operation risk management framework of an organization because organization sustainability depends on their operation risk management framework. Because they might not be sustainable if they don't manage their operation risk in a proper manner. So, therefore, rating agencies are very much particular about operation risk management framework and the quality of operation risk management of an organization. Then not only the rating agencies, but investors also. Now, if they find that, not the rating agency, if they find that the organization doesn't have a proper operation risk management framework and their operation risk management is weak, then their ratings invariably go down. Then the investors also, they won't come and invest in the organization if they find that organization doesn't have a proper operation risk management framework. Even the research analysts also are very much concerned about organizations' operation risk management methodology, because they do research on certain organizations. The performance of an organization also depends on that. Now, they often ask whether an effective operation risk framework is in place, sufficient capital is being held to protect the firm from a catastrophic operation risk event. These are the two main queries made by these parties. In one side, whether the organization has an effective operational risk framework. That is in one side. The other side, whether they have sufficient capital to face with any catastrophic event. Right, now I think we have just gone through these things. Now I will now go into this loss data collection programs and risk and control self-assessment things.
Sir, can you please explain a bit on loss data collection programs? The loss data collection program, maybe like an example or something?
Example?
Yes.
Right. No, it's like this. Now, when in the organization, now you need to you need to send a circular all over the organization to say that, to report any operational losses happen in the organization everywhere. It can be a business unit, it can be a department, it can be any other type of unit. So for all these people, there should be a methodology to report operational loss to the operational risk department. So that particular circular should be there. That enforcement has to be done. So what happens is, now when operational loss happens, then primarily that particular department has to inform that to the operational risk department. So that is the process. Not only that, it has to be informed to the audit department also. So only thing is, now this is people are little reluctant to do that because they don't like to report their losses. No? That is the issue. But if you can make it a compulsion, then they would have to do it. Otherwise, they would be found fault with. So therefore, there should be a methodology to report loss data or report losses when it happens. So, but the issue is, sometimes when a loss happens, the branch people or the business unit people may not be competent enough to report that loss in the proper category. That is the issue. That may be an issue, but when the loss is being just described, the operation risk management department can do the correct classification. They can do the correct classification. So there should be a metrics to report these things. Now, for example, as I told you, there are 7 risk events. Now, those risk events have been discussed. We discussed those risk events earlier. These are the risk events, right? Internal fraud, external fraud, employment practices and workplace safety, clients' products and business practices, damage to physical assets, business disruption and system failures, execution, delivery, and process management. Now, these are the 7 risk events which can happen. All risk events has to be classified under one of these. Now, that's what I now see. Since you asked that, what is the loss data collection program? So that program is this. So there's a database managed at the operational risk department. Now that management is done, populating the matrix. The matrix is prepared. In one way, or in one side, you have the risk events. The other side, you have the business, call it business lines, we call it. Business lines. Corporate banking, treasury, treasury and sales. Likewise, you have 8 business lines. You have 8 business lines, right? So 8 business lines and 7 risk events being taken into, say, sometimes we take business lines in horizontal axis, and vertical axis you can take the risk events. So then when a risk event happens in a particular business line, so then you have to report it in that. So I will show it to you. Oh, it's like this. So I will show it on the matrix, and that is how the loss reporting is done and loss database is maintained. Is that clear?
Yes,
I
sir,
can just
business lines are the Basel 3.
Basel 3, Basel 3 business lines. Yes, those are the business lines. So those business lines you can put in one way. The other way you get the risk events. So I will show it on the board, right? So you can have risk events in this side, right? 7 risk events. There are 7 risk events. Then you need to have 8 business lines. Right? Now, internal fraud. External fraud. Then you have clients, products, and so you have 7. And this side you have, say, retail banking. Corporate finance. Trading and sales. Okay, likewise, you have 8 business lines. Now say, in the corporate finance division say some internal fraud happens. Say the loss is say 2 million. The loss is 2 million. So then that is reported like this. Corporate finance, a fraud, internal fraud. So it is marked here. So the amount is 2 million in millions, right? In millions you mark it and you say 1. If there's another loss reported in the same business line, and that is 3 million, then this is being changed to 5 and number of events become 2. So that is the way it is being reported. Is that okay? Now, say, now I have just given you an example, right? So this is the matrix. In the matrix, one side we have the risk events, internal fraud, external fraud, and so on and so forth. Then the other side you have the business lines. Now I have taken an example. Say, assume that there was a fraud, internal fraud happened in the corporate finance department. The value was 2 million. Then at the first place, it has to be reported there. So then that the particular cell, you have to report 2 million. And there's another compartment on that particular cell. So you have to put 1. That is one event there. Say, there was another fraud, internal fraud in the same department, right? So that is 3 million, say. Now what is the loss amount there? 5 million. 2 plus 3 is 5. Then how many events? 2. So likewise, those things being updated every day when the loss has been reported. You got my point? That is how these loss database is maintained. The losses are classified under risk events and business lines. And the values are given there. Not only the values, the frequencies are also given. Now, for example, say, in the corporate finance department, say internal frauds, say 4 instances of internal frauds reported, right? Then the frequency would be 4 there. So likewise, you get the frequencies also reported. But to do that, you need to have this database in a central place. Everyone cannot do that. One place it should be there, some centrally located place. And all the losses being reported there. As and when it is reported, it is been updated. Is that okay?
Yes, sir. This is done quarterly. That's daily. Oh,
Yeah.
any frequencies there? That standard frequency. That.
Yeah, the frequency means now, as and when it is reported, the frequency is to be updated. No?
Yes.
That is how it is done. So then, say after 1 year, you can look at it and see how many risk events happening as internal frauds, and what was the value. So that can be taken for each business line at the end of the day, or at the end of a year or whatever. That can be done. So this is a cumulative type of a thing where you have to, update every day.
Yeah, it's ongoing monitoring one, but the higher management monitoring can be happened.
Yeah, there is a monitoring thing that should be there. So then the reality here, the advantage is you are in a position to see what type of risk are very, very, high impact risk can be identified. And the frequency of risk also being taken into consideration by looking at this. So this is the most important thing in loss data capturing. We call it loss data capturing. And there should be a way, and the organization should have a proper idea. All the employees should have an awareness on this. Then only it is to be reported. Now it is being reported. So there's no, sometimes there's a reluctance in most of the departments to report losses. That is the normal way, no? That is the normal nature. But there should be a, you say, I think when I was at Bank of Ceylon, we had the methodology. We had we appointed operational risk coordinators to each and every branch, and that coordinator's responsibility is to report that type of losses, and he or she is responsible for that reporting. But that coordinator should be a some responsible type of an officer, say A-class officer maybe. Then those coordinators, they just report the things without any reluctance. And the other thing is, this is very important because you need to have a rapport with those people. Operation risk department should have a good rapport with those operation risk coordinators, and they should be educated on this. Then only you can do these things without much of a problem. Because people don't like, normally the managers, they don't like to report their losses. That is the issue. But if it is not taken in that manner. But the other thing is, now when the internal audit people and all, they also should make it a compulsion. Now, if they have not reported, then that is also, that is also taken as a serious type of lapse. So there should be that type of culture has to be developed. Not that easy. Not that easy. But when you develop that culture, it will be smoothly. We can run it smoothly. Now, what about your organization? Do you have that type of methodology to get the operation losses collected or maintained in a database? Is it in operation? What do you say? Yes, there are several people here, but they don't talk, no? Yes, Suresha, what do you say? You have some operational thing here there in your organization to collect loss data?
So since it's a international bank, definitely it should have, but it's done at the headquarter level. So I'm not aware what's done. But we do have responsibility as officers that once like we with the stakeholder, the sovereign liability.
Even the regulators now, I can remember the regulators also just imposed that rule. They said that when you manage operational risk, you should have a coordinator in each and every branch to report to the operational risk management department. So these people will look at the branch level operations, and they just do that. And even internal control. Now I think in some banks, the branches will have internal control officers. Internal control officers are there. So that is another way. So if you can select internal control officer to report these things, that is also a possibility. So there can be several methods used in several organizations. So then you can see how the things can be really executed. The problem here is, unlike in credit risk and market risk, it is very difficult for us to assess operational risk. That is the most difficult issue to handle. Then we will see how we can do that, the assessment type of things. Right, now we can go to the assessment of operational risk. Now there you have a thing called risk and control self-assessment. Risk and control self-assessment. Now you remember, no? Now earlier we had a one. Here you have seen some tools here. Here. Now just look at these things. Under the operation risk management, these are the tools. One tool is loss data collection program. That's what now we have already discussed. Then the risk and control self-assessment. Then scenario analysis activities, key risk indicators. Then the reporting. So those are the tools which the banks or the financial institutions can use in their operational risk management. We now talked about this loss data collection program. But though we say these things, it is little difficult for us to just implement it in an organization. You need so much of effort for that. And it cannot be done in, say, in a short period of time. It takes a long time to have it established in the organization. That is the other issue. And even this, the second part, the risk and control self-assessment also, another factor. But what I feel is, if you are if you have a concern on these things, you would be in a position to look at your organization's methodologies or organization's practices with regard to this loss data collection. I really like to get your ideas about those things. I think most of you are from banks, I think. Invariably for any bank, there should be a loss data collection program. You just see that whether you have anyone, I mean, you might have not come across those things, but there should be. If you can just remind and see, recollect and see whether there's any program in your bank for the loss data collection. Yes, you can discuss. You can discuss. Yes. Yes, Lakshan, Udena, Anjali. So what you can say now with regard to the loss data collection program in your organization? I think all the banks in the country, all the banks in Sri Lanka should have a loss data collection program. They should have. You might have not come across, I think, but anyway, if you have such type of things, you just talk and see. I think that will be very much important to other people also. This type of discussion would be very much important. Because if some people are not very familiar with these things, they can get an idea. They can implement those things in their banks. I don't know. If you are capable enough, you can do that also if it is not been done there. But you see the importance of having that type of a database, because it is very much convenient. If you have a database, then you can see what are the operational strengths in the organization. Yes, Udena? Now, since we have now discussed about loss data collection program, now we need to go into risk and control self-assessment now. So then I will just go into that. Can you see the slide on the screen? Risk and control self-assessment. Can you see that?
Yes, we can see. Sir.
Right. Now, introduction to RCSA is defined as a systematic, rigorous process which leverages the collective knowledge of individuals within the organization to proactively identify, assess, mitigate, control, monitor, and report significant risk in business lines after evaluation of operational risk drivers or the causal factors. Now, it's like this. Now, you all know, in an office environment, you do several processes. Basically, say, for a bank's customer area, you need to do some account openings, cash withdrawals, cash deposits, loan, granting of loans, or such type of thing. For each of these activities, there will be a process. There will be a process. Now, in the process, there are several steps. Now, for each step, there's an inherent risk. There's an inherent risk for each step. Now, if you take current account opening of a current account, there you have a process. The customer comes, the customer gives an application, then you need to get the signature cards, and there should be an introduction, and the person has to deposit money, then checkbook has to be issued. Likewise, now you have several things in the opening of a current account thing. And the identification of customer is very much important to open a current account. So likewise, you have several steps in the process. Now, when you go through this RCSA process, what you do is you identify several activities which you do. Now, for example, if you have taken a branch into consideration, in the branch, you have several things to be done. Opening of current account, opening of savings accounts, granting of loans, cash withdrawals, cash deposits. Likewise, you have several things. then issuing of letters of guarantees. So likewise, you have several activities. Now, for all these activities, there's a procedure, there's a process. And those process consist with several steps. For each step, you can identify there's an inherent risk in each step. Now, if I give an example, say, the identification of the customer for a opening of a current account. So that is the step. Now, how are you going to identify a customer? You just look at the signature card, look at the introduction or whatever. So that those are the things. But what is the risk? A person can impersonate someone or fraudulently just appear as some other person with some fraudulent NIC or whatever. So that is a risk. That is an inherent risk. Right? Inherent risk. Now, if you identify the inherent risk of this step, for each step, you need to identify the inherent risk, the level of inherent risk. But for that, to mitigate and control, what you need to do is, you need to identify the control aspects. What are the types of control you have to include in that process? So we have to check the NIC, we have to check the introduction signature, whatever it is, and we have to confirm that introduction. All these things are there. So in order to control that risk, so you have an inherent risk, you have controls, but even after controls, risk might be reduced, but there might be a residual part of it. So then if you take that into consideration, you can see for each and every step you have an inherent risk. Then you have to have some controls for that. When controls being imposed on that, then though you do that, there will be a residual risk. But that residual risk may not be equal to the inherent risk. It is more or less less than the inherent risk. But if the controls are not strong, then what will happen? The residual risk is more or less similar to the inherent risk. So residual risk can be minimized by having strong controls. So that is what you mean by this assessment. Now, when one assesses this scenario, they go through each and every step and see whether what is the inherent risk, what are the controls available, and with the control, what would be the residual risk. If the residual risk is very much lower than the inherent risk, then you can be satisfied that the controls are very strong. If the controls are weak, then what is happening? Inherent risk may be very much similar to the residual risk. Now you can see the way you can apply these things. But I think it is better if you can go through this first. Right, I will just explain it on the board for the time being. Now, when you just get a process, and in the process you have several steps: 1, 2, 3, 4. Now, inherent risk is there, and you have controls and residual risk. Inherent risk is there, and controls are there, residual risk. Now, if you have some inherent risk here, of course, you need to have controls here. So you can put it in red. Controls. As a result of these controls, the residual risk can be lower than the inherent risk. Then you can have this way. Now, this is the normal study done under the risk and control self-assessment. Right, we will see what is this, and through this description, risk and control self-assessment is a systematic process and a common risk management approach that addresses all the 4 steps of risk management. They are the identification, measurement, monitoring, and control. RCS is conducted on an enterprise-wide basis for multiple operating units. Now, we do it unit-wise, engage in different business operations and facilities in different countries. RCSA results in the identification of control gaps, and consequently the appropriate corrective actions to be taken. Now, as it is, when you see that the residual risk is more or less similar to the inherent risk, the meaning is the controls are weak. Then invariably the controls to be strengthened. That is the knowledge, or that is the sense we derived from risk and control self-assessment process. The risk and control self-assessment methodology involves review and assessment of the operational risk across the bank, as well as the internal controls designed to manage those risks. RCSA is used as a tool to assess risk in all the bank's activities and processes against a menu of potential operational risk vulnerabilities. The RCSA process should be internally driven by conducting workshops across all the business units of the bank to assess risk through specific templates designed for the purpose. Now, this is actually a rather very comprehensive activity where you have to identify competent people to do this, and through that persons you can just do this RCS activity department wise and branch wise. Now, these are the objectives of RCSA. Quantify the risk exposure to operational risk, understand risk profiles across and business lines, all business lines, and associated activities. Identify and rank operational risk as high, medium, and low. Assess the strengths and weaknesses in the operational risk control environment. Prioritize management action for high risk areas. Determine compliance to policies, procedures, and regulations. Now, these are the benefits. It really enables ownership in OR. RCSA helps in identifying risk and control owners. Accountability for management of risk and control is ensured. Enables proactive management of operational risk. RCSA helps in proactive identification of risk. Through control testing process, RCSA enables effective and proactive risk mitigations. Now, this is a very comprehensive process. And in order to get the first-hand experience, you need to do it. Now, in order to get it to the risk culture, RC has to be rolled out across the bank and across departments. It ensures participation by majority of the bank staff in risk management and thus helps in creating and spreading a risk awareness culture within the bank. Now, I will really explain these things through an exercise. Right? So for that, we will have a hypothetical banking office. So there, you need to tell me what are the normal operations taken place in the bank. Bank's customer service area. So we can take one by one and we can identify the steps there. After identifying the steps, we will be in a position to assess the inherent risk there and the available controls to deal with that inherent risk. And afterwards, after applying the controls, what could be the residual risk? So that type of assessment we are doing through RCSA. And since it is being done by the grassroots level staff, so it can be a emanating of the culture, risk culture towards all the business lines and branches. RC has to be rolled out across the bank and across departments. It ensures participation by majority of the bank staff in risk management and thus helps in creating and spreading a risk awareness culture within the bank. Enables synergy with work carried out by internal audit department. So internal audit department can also be come together. RCSA can be used to support the process audits conducted by internal audit department to identify process and control gaps which could result in risk. The key risks which emanate from RCSA results can be used to build business unit wise and location wise risk profile. Which in turn can assist in the development of RBIA plan. Now, these are the steps in order. First of all, process mapping. Now, in order to get the process mapping, you need to identify the activities of your subject business unit. Now you can see the step-by-step process there. Step 1 is discussion with line management and unit head. Now, I think this is a practical process you can do in your organization. At the beginning, what you need to do is you have to discuss with the line management and unit head. Review of process documents and audit reports. That is the first step. Now, process documents means now for most of the banks or branches, they have their own process documented. And audit reports are also there for these processes. Interviews and with liaison officers and process owners. Then step 2 would be preparation of RCSA template outlining the risk and associated controls across processes. Mapping of loss events and risk drivers. Step 3 would be finalization of RCSA template through joint review by ORM. Because the templates has to be designed first. Now in that design process, you should get the involvement of branch staff and its branch staff assessment. So that is why we call it self-assessment. Self means the branch people or the business units people. Submission to business units for control testing and risk assessment. Then the step 4 would be identification of significant risk in the facilitated workshop, working out a risk mitigation plan, assigning responsibility and fixing target date for resolution. So these are the main steps of risk and control self-assessment. Now, when you check this type of thing, now this risk rating grid, you can see the impact have several alternatives. Impact can be significant, impact can be major, impact can be moderate, impact can be minor, impact can be insignificant. So, but you have to quantify these terms. Now, what do you mean by significant? Above how many rupees? Say rupees 100 million or 50 million or whatever. So that all depends on your organization's needs. When you say, when someone says a significant loss as 50 million, that is according to that institution. If you go into another institution, the significant may be only 10 million. So likewise, this type of quantifications are very much special or very much specific for that particular organization or particular branch. But in a bank point of view, if you go for a branch also, you need to have the branch grading or whatever. Then the branch should decide what do they mean by significant, what do they mean by major. So likewise, you have to get the figures there. Then moderate, minor, insignificant. Insignificant means if it is less than say rupees say 10,000 or so. So likewise, you can have that way. Then the other side is the frequency of happening. Rare, unlikely, probably or probable, likely or certain. So there you can see the rare means it might happen once in 10 years. Unlikely means it might happen once in 5 years. Probable means it might happen once in a year. Likely means once a quarter. Once in a month, certain. Now you see the combination. Significant and rare events can be taken as low risk. Significant and unlikely can be taken as medium. So you can see the grid there. Now, the risk level is high when it is red. The risk level is low when it is green. Risk level is medium when it is amber. That is how it is explained. This rating grid is explained in that manner. The control is defined as any measure taken by management which either reduces the likelihood of an incident occurring or reduces the potential damage. We call it the severity arising from that incident. Control includes measures to ensure adherence to management's directives, policies, and procedures, as well as conformity to local laws and regulations. Now, when you say control assessment, the control is defined as any measure taken by management which either reduces the likelihood of an incident. Now, the meaning is this. Now, when you try to control risk, the risk has two components. One component is the likelihood of happening or frequency. The other component is the severity or the impact. So when you do controls, it might reduce the frequency as well the severity. Or sometimes it might reduce the severity only, not the frequency. In some controls, when very strong controls are available, then you can control the both components, the frequency component and the severity component, both. The factors that determine the effectiveness of the control. Control is inappropriate for the risk. Staff are averse to implement the control. Now, these are the factors which determine the effectiveness. Now, if the control is inappropriate for the risk, the control would not be strong. No, it would be, it is in vain if you do that. Staffs are averse to implement the control. Cost of control implementation is perceived as high. So if people think that to have these controls, it would be a very high cost. So then that also will weaken the effectiveness of control. Control is overmatched by other priorities. Control is not clear or not understood. Unclear responsibility, no accountability for control. Control is redundant in the current environment. Control is not worth the resources expended on it. Decision taken to rescind the control. So all these things will go against the controls. Now, when you do this residual risk assessment, now as I told you earlier, the residual risk is the inherent risk minus controls. So you can see, now you can compare the earlier risk grid. Now here, this is the risk rating grid, this is the inherent risk. This is the inherent risk, right? So then afterwards you have another grid like this. This is residual risk. So therefore you can compare these two grids afterwards. So then you can see whether the controls are effective. Right. Now we will just look at the risk response and risk treatment in There you have the identification and listing significant risk assessed to the risk assessment process, suggest risk response planning, and design template for plan of action given all potential pertinent details. Responsibility allocation to person. Now, all these things will be done after the risk and control self-assessment process. Right. Now, in order to get this risk rating grade, now this is the process steps involved in RCSA. So I just want to tell you the way it is to be mapped. Now, I will take a hypothetical bank branch and just explain how we can do this RCSA process. Now, as per these steps, the first step is to map the process. Before mapping the process, we should identify the functions of the branch unit. Right. So, as an exercise, we will do that. Now, I will just get a hypothetical branch of a bank. So, first thing you need to do is you need to just list the main functions of this bank branch. So, you just put it. Just give the names of the functions or give the functions of the bank. Right. I have seen some queries from Sumudu and Sumudu Dilanga. So I will just explain on these risk registers at a next time. I will explain it. Even today's this thing you can just engage with the exercise now. As I told you, now we have just taken a branch, hypothetical branch, and just list the functions of that branch. So you need to give one or two functions of a branch. Just give it as a message. Then I will put the things there. Because I need to get your engagement here. That is why I just ask you to do that. Just give one of the functions. Then I will put down the things there. Yes, Sumudu, I think you have given some list. Yes, opening savings accounts, FD accounts, cash deposit and withdrawal process, loan application process, loan appraisal process, loan disbursement process. Yeah, good. I will put those things there. Now I have just put three things: opening savings accounts, opening current accounts, loan application process. So I think we can just take one of it as the first function, opening savings account. Now what we need to do is we need to just identify the steps. The process, you should get the steps. So what are the steps? Getting the application. Customer identification. What else? So you need to have the steps of the process. Now, Gresha, now you can just see what are the types of steps you have to fulfill when you open a savings account for a customer. So at the beginning, the customer will give you an application. So receiving the application is the first thing, no? Getting the application. Then you need to do the customer identification. So likewise, you have to just do the signature cards and that verifications and all. Then the customer will go and deposit money. So such type of things. Right. Now I have just given certain steps on the opening of a savings account. Anyway, issuing the passbook can be taken the last one. Right. Now just look at the the board, I have just taken into consideration the opening of a savings account. Now that is opening savings accounts. That is the process. Now the function is opening savings account. So I have just taken the process, but I have taken it as it is. But you can have a better list of steps. So whatever it is, but what I want to do is I just want to tell you how we can do this risk and control self-assessment in a branch environment. Now, in the first place, what you need to do is ask the branch people or the business unit people to identify their functions as you identified now. Sumudhu has given opening savings accounts, FD accounts, cash deposit and withdrawal process, loan application process, loan appraisal process, loan disbursement process. Now all these processes have been identified by Sumudhu. In the same manner, all others can identify that type of processes in the bank branch. I also have just identified 3 functions. That is, I identified opening of savings accounts, opening of current accounts, loan application process. So for you to give a demonstration, now I have identified the steps of the function of opening of savings accounts. There, the first step is getting the application from the customer. Getting the application from the customer. Then customer identification. Obtaining signature cards. Entering customer data into the computer. Completion of passbook. Getting the first cash deposit. Issuing the passbook. So that is how I have taken it. But in the same manner, you should discuss with the branch people and get their functions identified. And ask the branch people to list the steps included in each function. Now, as an example, as a demonstration, I have taken the opening of savings account as the function. For that function, the steps are getting the application, customer identification, obtaining signature cards, entering customer data into the computer, completion of passbook, getting the first cash deposit, issuing the passbook. Right? Now, if you are going to do it seriously on a practical basis, I think you need to have more steps. Because when the passbook is the completion of passbook, there you need to do several things. You need to get the signature on the passbook, and there will be some sticker is based on that, such type of things. And the customer data has to be taken onto the passbook through a printer. So all those things will be there. But in a practical scenario, you need to list all those steps. This is a classroom exercise now, so therefore I have just put it that way. Right? So now you have to get each of these steps. And you have to have an assessment of inherent risk of each of these steps. Now, just look at it. Now, I just start with the first step, that is getting the application. Now, when getting the application, could you see any inherent risk involved with that getting the application? even though I put it as getting the application. Now it's a real complicated process. Why do we say that? What are the types of inherent risk involved in that? Yes. Yes, that can be an inherent risk. Now, this is only one thing. Now, as it is, as Sumutu said, it is getting the application. There can be incorrect data or mistakes made by the customer, which need to be identified and corrected. Yes, very good. So that is one type of a risk. So you can say erroneous filling of application. So that is one risk, one inherent risk. Anything else? The customer can have some ulterior motives in opening the account. So that's the real danger for the bank. If the customer is a money launderer, invariably the bank will have to face the music, right? Yeah, he might be in blacklist. Therefore, that is another inherent risk. So the customers, what you say, whether the customer is, you say, he is into the money laundering. Whether he, yeah, PEP or whatever. Yes, that's good. So the particular due diligence has to be maintained. We call it due diligence, customer due diligence, CDD. So that customer due diligence would be a risk, inherent risk. So we can say lapses in customer due diligence. We can put it that way. Those are the risks. Lapses in customer due diligence regulations. Now, I have now taken that step as the first step. The first step is getting the application. Inherent risk. Errors in the filling of application. Errors in the filling of application. Then lapses in CDD process or CDD requirements. Anything else? Anything else you identify on? Yeah, obtain mandated. No, those are the control. We will come to that. Now we have identified two inherent risk. KYC requirement, yes. We can say lapses in KYC requirement. Anything else you find on getting the application? Now, first of all, we said the errors in filling the application, that is the first thing. And then we took, identification documents, we will come to that later, because we have taken identification also as a step. Therefore, we can just take that into consideration when identification comes to the line, right? Okay, good. Anything else coming under getting the application? Now, do you think that the savings account holders, whether they need an introduction? Do they need an introduction? No, they don't need an introduction, but the only thing is, I can remember now, those days, the signature has to be witnessed by another customer, by the bank. That was the earlier identification process, but nowadays, the banks go by the NIC. They go by the NIC. And there's another risk here. Erroneous filling, it's rather than erroneous filling, the customer can give false information. False information can be given. It is not an error. It is a, on his own, he can do the wrong information. So even though the information is wrong, there's no error there. So that's what you call the giving false information on the application. Right? That is also a risk. Right? We can put that way. So that is also an inherent risk. False information in the application. Right. Okay. Now I think these 4 things are enough for our discussion. Now we have started doing the risk and control self-assessment process. Where we have taken hypothetically a bank branch, and we have identified the functions of that bank branch. And we have taken 3 functions, that is opening of savings accounts, opening of current accounts, then loan application process. Now, from that, we have taken 1 function, that is opening of savings accounts. And there, the next thing is to identify the different steps to do that function. The steps being identified as, the first step is getting the application. The second one is the customer identification. Then obtaining signature cards and all that. So right, getting the application. Now under the getting the application, we have identified inherent risk in getting the application. The first inherent risk identified is errors in the filling of application. So then the second one is lapses in CDD requirements. Then lapses in KYC requirements. Then false information in the application. So those are the inherent risks which we have identified for that step. Now, To open the savings account, there have been several steps, but we have taken only one step and identified the inherent risk. There can be several other inherent risks, but we have not taken those risks. But if you feel that there have to be many things to be added there, we just put it there. Tirukuma, you can just think about something else and just put. You can have another inherent risk identified. Can you? For this, right? Now, when we identify the inherent risk, what we should do? Then we should see how we can mitigate that inherent risk through controls. Right? So the first thing we have identified as a risk was erroneous filling in at the application. Application filled in an erroneous manner. So what is the control for that? To mitigate that risk, how do you introduce a control? So what control you should introduce for that? Yes. What is the control you should introduce? Check in the documents. Yes. Check in the documents. Right. So we can say the control available is to check the documents with the available sources. There can be the person's identity card will be there and his address or whatever. All those things will be there. So you can just say that check in the document with available sources. Or we can say check in the application with available documents, right? That way we can say check in the application with available documents. Or we can say check in and verified correct. Check in and verified correct. So that is the control. So you can, then we will identify the controls also. So we identify the controls. Now when you identify the controls for errors in the filling of application, you can say check in and verifying the application with available documents. So that is the control. Check in and verifying the application with available documents. So that is the control for this. Errors in the filling of application, the control is checking and verifying the application with available documents. Right. Then we go to the next step, that is the next risk, lapses in CDD requirements. So how are we going to deal with that? How are we going to deal with that? So what you can do is you can just see whether checking with documents is correct. So then, so the next one, that is the lapses in CDD. So then there will be a form, no? So that also we can get filled, but not only that, we need to check whether the person is a PEP or that type of things. So we can say verification on the customer's genuineness or whatever. Or verify the customer with internal checklist for collecting mandatory KYC. Yeah, very good. Yes. Internal checklist for collecting mandatory KYC information verification documents. Right, very good. Because now you normally get a bill, electricity bill or water bill or whatever it is. So that is one thing. Whether the person is the owner of the particular house or whatever. So that type of things you need to take. So those are the internal checklists for collecting mandatory. That's a good way. internal checklist for collecting mandatory KYC information verification documents. Very good. So we can put that as the control for this. Now, for both these things, you can say internal checklist for collecting internal checklist for collecting mandatory KYC information verification documents. Right. Now, when you have false information in the application, so that also can be controlled through that verifications. Right? Through that verification, you would be in a position to check whether the information is true or false. So I think for getting the application, when you say getting the application, that is the first step. Now we have identified the risk in that first step as errors in the filling of application, lapses in CBD requirements, lapses in KYC requirements, false information in the application. Now those are the identified inherent risk in getting the application. So in order to deal with that, in order to mitigate those inherent risks, we have identified the controls. The controls are checking and verifying the application with available documents. So that is the first thing. Then internal checklist for collecting mandatory KYC information verification documents. I think that will do for all these inherent risk, and the control can be inserted through that. Good. Now, if you take the next step is customer identification. The next step is customer identification. So, what are the risks in the customer identification? Yes. What are the inherent risks in that? Yes, the person can give a false identity. This is an inherent risk, is it? Customer can provide the false identity. False identity. So that is an inherent risk in the identification. So anything else in that customer identification? Right, we can, I think that is the main inherent risk in identification. Customer might give false identification. False identification given by the customer. Right. Now, in order to check whether the customer's identification is correct, what type of steps you need to take? Or in other words, the controls. What type of controls you should exert there? To avoid false identifications. to avoid false identifications? Yes. Discussion here. Discussion is one way. Yes, you can have a discussion with the customer. That is one thing. But I think there are some other ways of doing it, because you can have a, say, if the customer, if the person is say, if he can provide some water bills, then you can see the name there. No? You can see the name there. The water bills, electricity bills, and all that. You have the, or even some tax payments or whatever it is. So those are the proof documents. Yes. But only problem here is, even though you do that, you have that risk, because there are several people who give false identities. So that is a risk. But you can avoid that type of things by to be careful. You need to have, as you say, a discussion, a frank discussion with the customer. And if you are clever enough, you can ask ask appropriate questions from the customer to get some real identification. Another thing is, you can just ask him, what is your identity card number, or whatever it is. So normally, if an identity card is bogusly prepared, the number may not be very much familiar to that person. Very good. Yes. Yeah, that's a good way. So those are the controls. Yes, those are controls. Now we need to identify the risk, and the risk is the mean false identification given by the customer. So as it is now, I think the Sumudu's this particular thing, that statement would be a control for them. Training programs for document officers for identifying fake documents. Right, very good. Then the other thing is, you need to train the officers to discuss with customers and verify the genuineness of the customer. So that is another way. As Thirukumar said, you can have a discussion. Through the discussion, you will be in a position to just verify the fakeness. Right. Anyway, now since we have taken customer identification as the next step, there we have identified the risk as false identification given by the customer. So in order to avoid that, we can train our officers to identify the customer through a discussion, or verifying the genuineness of a customer through discussion. So that is one thing. The second thing is, they are also, training will give a big support. Training programs for document officers to identify the false documents, fake documents. So these can be taken as controls. Okay. And I put it as officers to discuss with customer and verify the genuineness. So through the discussion. The other one is officers to be trained to identify fake documents. Fake documents. So these are the types of controls you can put there. Right. Now we will see the structure of it. You can see the structure of it. Now say, in the first place, we have identified or we have assumed a bank branch. Now we are going to do the risk and control self-assessment process for that bank branch. And in the bank branch, first of all, we need to deal or we need to talk with the staff concerned. And we should ask them to list their functions. Because this is a collective type of a project, a collective project by the branch staff. It can be led by the branch manager. Then we can ask someone to list the functions of the bank branch. So we have identified some type of functions, and we started with the opening of savings accounts. That is the function we have identified. And in that function, there are several processes or several steps to fulfill that function. The first thing is getting the application. Second thing is customer identification. Now, when you say getting the application, there are inherent risks in that step. Those things we have identified. Then we go to the customer identification. There also we identified the inherent risk. Then we identified the controls also. Then we need to have a color code to give some color for this risk, inherent risk. Now, inherent risk you have identified now one by one. For each one, you need to put a color code. Now that putting of that color code would be according to this. I will show you that. Now here. Now with regard to the inherent risk, you need to go through each risk and see what color is applicable for that risk, inherent risk. Now, for example, now I have taken the opening of savings accounts as the function, and that function, the first step is to getting the application. And we have identified the inherent risk in that getting the application step. The inherent risk being identified as errors in the filling of application, lapses in CDD requirements, lapses in KYC requirements, false information in the application. Those are the inherent risks we have identified. Now, I just take errors in the filling of application. So, what type of a risk it is that we need to give a color code for that? Right. I am just asking you, in your opinion, the errors in the filling of application What is the nature of that risk? What type of a color code you can give it for that? Give for that. Yes. Then you have to justify. You need to justify that. Yes. Now just look at this. The risk grid has two components. One component is the frequency of happening. The other component is the impact. So for that, what do you think? I am referring to the errors in the application. Errors in the filling of application. Errors in the filling of application. Now, what do you think about its frequency? So you can have your own thinking for that. What is the frequency for that? Errors in the filling of application. What is the frequency, normal frequency? Now I am asking, is it highly frequent or less frequent? Yes. It is highly frequent or less frequent? Yes, it is highly frequent. Then you should really go to the scale up to this. So that should be certain type. And if it realized or if it materialized, what would be the impact? Would it be a significant impact or a moderate or minor impact? Yes. What do you say? The impact. So you need to have some thinking for that, right? You need to have some thinking for that. The frequency is high. Yes. I'm just referring to the other component. Other component is the impact. So this errors in filling in the application, what would be the impact? What do you say? Is it a minor impact or moderate impact or major impact? That's what I'm asking. Yes. Maybe significant, yes. Or high impact, significant, yes. Tirukumar said it is significant. Just see. Yes, significant is very high. Okay. It can be, yes, it can be. So therefore, the particular color code would be red, is it? The color code applicable for this inherent risk would be high. That is red. That is red, is it? All of you agree with me that on that? All agree that the color code should be red? Now, when you have significant and high interact, then you, yeah, yes, that should be red. Yes, that should be red. Right. Now we will go to the other part, the control part. Now, what do you think? After inserting the controls, what are the controls we have suggested? We have suggested several controls. Checking and verifying the application with available documents, internal checklist for correcting, mandatory KYC in the verification of documents and all that. So when you do that, when you verify those things in that manner, you will be in a position to avoid the risk, the inherent risk we have identified. So therefore, what is the probability of that? So then we need to get to the next risk grid, that is the risk grid on residual risk. The risk grid on residual risk would be this. This is the residual risk assessment. So inherent risk minus controls is the residual risk. So though we got a red color red for the inherent risk, what color you get for residual risk? That's what I am asking. So you need to check the residual risk by taking into consideration the controls. Since you have controls of this nature, you can expect the frequency of this risk might come down. And even not only the frequency, the impact also might come down. So in that case, the color code might change. So what do you think? Now you can visualize and see what could be the color code for the inherent, residual risk. Now, if the controls are strong enough, invariably the residual risk should be lower than the inherent risk. If controls are strong enough. But as it is, when you look at it, you can just gather that these controls are strong enough. Controls are strong enough. Right. Now I am just asking you, as per your visualization, what is the color code you can give for residual risk? I am referring to the getting the application step. Getting the application step, we have identified certain inherent risk, and we have identified the controls also. After inserting the controls, what could be the residual risk? So I am just asking for the color code. Now we got color red for the inherent risk. Yes, Suresha, yeah, it could be green, yes. Yes. Why it should be green? That's what I am asking.
Because basically, from the mitigating factor, after careful scrutinization, we can make that application a complete application.
Yeah,
Otherwise, we
good.
can't open the account.
Yeah, that's correct. Yes, correct. Because the thing is now, since we have given the appropriate controls, you can expect the residual risk to be very much lower than the inherent risk. So that's a correct application. So therefore, as Suresha said, we can say it would be green. It would be green. So it's a I mean, fair enough. That analysis is fair enough. Now I think you might now get the concept behind this. Now what we did was, now we have identified the functions. Then we have identified the process to implement to get that function done, different steps. And for each step, we identify the inherent risk and the appropriate controls we have inserted. Now, for each of these steps, you need to do that. For each of these steps, you need to do that. So this is a type of an exercise you need to do. And for an example, I have taken into consideration the opening of savings account as the function and identify the different steps. The first step, the getting the application. So then we went through the inherent risk and we went through the controls which we can insert, and we got an idea about the residual risk. So this methodology you have to follow throughout the function, because you did it for getting the application, then we did it for customer identification, then obtaining signature cards. There also you can get the inherent risk, you can get the controls, then you can get the residual risk. Then entering customer data into the computer. So that's another step. There you have inherent risk and the controls and the residual risk. Then completion of passbook. That's a separate case. There also you need to do some getting the signature of the customer. Then you have to put a sticker on that and get the passbook data into the passbook. And there also you might identify some inherent risks. And they are the same way you need to have some controls also. And the residual risk would be less than that. Then getting the first cash deposit. Then it has to be entered. Yeah. So there also you would have inherent risk. Now say for example, the customer would deposit say about 50 million rupees. The customer is going to deposit, say. Then it's a type of a money laundering case, maybe. Then you need to ask the customer how you have got this money, or he might say that it's a lottery win or whatever it is. So that's such type of things. Then issuing the passbook. Even issuing the passbook may have some inherent risk. Because sometimes you might give it to someone else. You have to be careful then again. Right. So I'm just giving you the way it has to be done. Then the assessment is done through a color code. You are not going to give numbers for that. That is the issue. That is why we call it very, very qualitative type of things here. But we try our best to get it quantified. Get it quantified. Anything you need to clarify on this? Anything you need to clarify on this? I think you might understand this. The best thing is to do these things. according to your institutional needs. Risk and control self-assessment. And it's a very good exercise for the branch level, because the branch should identify their own mistakes, own weaknesses, and see how they can get rid of those mistakes. And the customer service would be very much improved. You will see the benefits then and there. Yes. Now, do you have any issue in these the color codes? If you go again to that color code, now this is the residual risk assessment. Earlier, now you might remember that when we talked in terms of the inherent risk, you took this as red, because you take the highest frequency and as significant, the loss would be significant also. So then it is in this place, it is high. But after inserting the controls, this frequency might come down somewhere here, once in a year or so. But your significance also, it would be minor. In fact, also minor. So that is how it comes to low. That is why we can put it as low or green. If you are not very clear or not very confident about your controls, then the color may be medium, that is amber. One can argue in that manner also. I don't really find fault with that person also. If someone says that it should be medium, maybe that all depends on your confidence on controls. Confidence on controls. Anything you need to clarify here? Anything? Anything to be clarified here? Yes, Suresha. Chirukuma? Right. Now, we will again go to the presentation. Right. Now, as it is, the step 1, we have already done the step 1, discussion with the line management and unit head. That we have not done, but review of process documents and audit reports. Now, these process documents, normally in a branch, you get all these process documents. And for these process documents, you might have an audit report also. Then afterwards, you need to have interviews. Then you can prepare the RCSA template, outlining the risk and associated controls across processes. Now, that's what we have done now. We have done that to a certain extent. The mapping of loss events and risk drivers. So, Now, as it is now, you can just look at it. We did the process mapping first. Then we identified the risks. Then we assess the inherent risks. And we test the controls. Then the residual risk assessment. Now, after we assess the residual risk, you need to treat those things, because if you feel that your residual risk are so much higher than what you expect, then it really implies that your controls are weak. So you need to have a response for that, risk response, and you need to treat it. You need to strengthen the controls. Now, I think you got it now, no? You really got it. And these are the benefits. Right, now, after doing these things, for a branch or a business unit or department, the department people, together with the operation risk management people, will get a good idea about the risk profile of especially the operational risk profile of the branch or the business unit or the department. That could help them to have a more realistic quantification of operational risk. Now, they would be able to have some indicators to measure the operational risk. That we call key risk indicators. Key risk indicators. Now, the definition of key risk indicator is: key risk indicators are measurable metrics or indicators that track exposure or loss. This indicator becomes key when it tracks an especially important exposure, or it does so especially well, or ideally both. It should be an important exposure you are going to trace, and it will be done very correctly. Okay, I will just give you some better now just an illustration of key risk indicators. Now, when a key risk indicator process is there, I will illustrate in this manner. Now, if you take a bank branch, they might go through these processes, the teller functions. Through a teller function, there can be risk, manual error in transaction processing. So that can be a risk. Now, we can develop a KRI to have a trace on these errors in transaction processing. The KRI can be number of customers handled by a teller. Now, you all know when a teller handles large number of customers within, say, 4 to 5 hours, very large number of customers, then invariably the tendency of errors would be very high. Manual errors can happen if the number of customers handled is so much. That's a natural thing. And in this particular KRI illustration, number of customers handled by a teller is taken as a risk measure. And it says when number of customers is less than 150, the risk is very low because it really stretched in a period of say 5 to 6 hours. But it is between 150 and 250, it is taken as low risk. 250 to 300, it is medium risk, and if the number of vouchers or number of transactions higher than 300, is taken as high risk. Now just look at it. Though we have the number of transactions as the criteria, may not be true sometimes, but approximately or surely you can say it is the way. The KRI process monitors KRI values and compares them with threshold tolerance limits for certain potential risk. Now, these are thresholds basically. In key risk indicator process, you have to go by the thresholds, threshold limits. So, now here the threshold limit for a risky thing is 300. Medium risk is 250. If it is less than 250, it is low risk. Now, when developing KRI, there can be several challenges. Identifying limited but sufficient set of KRIs. It's a challenge because you should not have many number of KRIs. That will be a big nuisance for you. Setting benchmarks, thresholds for the KRI, that's a challenge, right? Tracking of KRIs on a regular basis. Scaling and aggregation of KRIs. Now, where these challenges can be addressed to developing KRIs in coordination with business. KRI development is a dynamic process requiring periodic reviews. Benchmarks derived using expert judgment for loss data. That is the now you can see the importance of loss data. It comes here also. Benchmarks can be derived using loss data sometimes. Now in a branch KRI development process, now this is given as an example. You need to develop an index, developing KRIs for each aspect of the index, setting threshold limits, getting the approval of the business heads, developing the data entry sheet, dashboard in the core system, collecting the data on quarterly basis, reporting to the relevant AGMs, DGMs, and the Integrated Risk Management Committee of the board. Now, the real purpose of implementing the key risk scorecard is to measure the current risk position of all branches. Now, I will give you some examples because these examples are not for your direct application, but to get an idea. Because in your circumstances, these KRIs may not be suitable, but you need to understand or you need to select the suitable KRIs for your environment, your organization's environment. That is what you need to think. These KRIs I have given as an example. Now just look at it. Number one, unsold audit queries divided by total audit queries. In other words, the percentage of unsold audit queries with respect to total audit queries. Now, the thresholds are given here. If the unsold audit queries are higher than 5% of the total audit queries, then it is taken as a high risk. If the unsold audit queries are less than 5% of total audit queries, then it is taken as medium level risk. But if you have no unsold audit queries, then the risk level is low. If you have even one unsolved audit query, that would be a risk. You know what is unsolved audit queries? Audit queries can come, no, for any type of an organization. But as soon as possible, they should resolve those things. Right. Then number 2, audit rating of the branch. Because the branches are normally rated by the internal audit department. Now, if a branch is rated at a lower rate, the branch risk level would be higher. Now, if the branch grading is less than C plus, then it is high risk. If it is B minus, it is medium risk. But if it is B plus and above, it is low risk. Then the number of BCP awareness programs per year. What do you mean by BCP awareness? Business continuity planning awareness. If we are not conducted any program in the year, then it is taken as a high risk. Once a year, it is only medium risk, and twice a year or more, then it is taken as a low risk. Then the 4th KRI, number of instances of generator and UPS breakdown. Number of instances of generator and UPS breakdown. Now, if generator and UPS breakdowns are 2 or more within a certain period, or say this month or so, if it happens 2 or more times, it is taken as high risk. If it happens only one time, it is taken as medium. If it happens, it never happened, then the risk is low. Then you have a thing called timeout. What do you mean by timeout? In the system, you get it. Timeout instances. When you say timeout instances, if you have more than 5 timeout instances, then it is taken as high risk. If it is more than 2, it is taken as medium. Less than 2, it is taken as low. Cash transaction per teller on average. Taken as high risk when it is more than 400. 399 to 300 is taken as medium. Less than 300 is taken as low. Phone-in transaction per phone-in teller. They are also the same type of criteria is taken into consideration, but number of transactions, the levels are lower. And PBO is the personal banking officer. Transactions for PBO teller. They are also the same thing. The number of ATM breakdowns, 10 or more is taken as high. 5, it is medium. Less than 5, low. Number of computers without updated virus guards. If you have more than one computer, it is high risk. If you have only one, then it is medium risk. If you do not have any computers without updated virus guards, then it is low. Staff awareness on new products. Now, less than 50% of staff be aware, so then it is H. More than 50%, then it is medium. 100% aware, then it is low. Number of instances of purchasing of forged foreign instruments. Number of loans transferred to NPA within 6 months of granting. So these are another criteria. Now, if a loan goes into NPA within 6 months from granting it, then it's a real risk operation. If it is 2% or more, it is taken as high risk. Less than 2%, it is medium, but you do not have any any loan goes into NPA within 6 months, then it is low. Right? Number of fake bond articles, there are several things. Staff training, absenteeism, punctuality, number of lost drafts, checks in drafts. Now, all these things can be taken as key risk indicators. I don't think that all these key risk indicators are applicable for your situations, but you need to think about suitable KRIs for your organization. That is up to you to decide. But this process is a very, very important process. Together with RCSA, if you can do this, then the validity of KRI process would be very high. Because you have a base to decide on KRIs. Any question on this? Any question on this? Now, you need to apply these things when you take the KRIs into operation. Those KRIs should represent each and every section of the bank. It should not be restricted to any one type of a department or one type of a branch or whatever it is. Everywhere, you need to cover the whole organization, whole enterprise to be covered with KRIs. The coverage should be there. Any questions on this? Any questions on this?
So these operational risk factors has to be included in this ICAP framework also?
ICAP.
Yes.
Yeah, of course. Because now that is the internal capital adequacy assessment process. Now, when you talk in terms of operational risk is also a risk where you have to provide capital. Therefore, the operational risk frameworks or whatever should be there to see that the quantified operational risk will be mitigated through a particular capital amount. So that is why we need operational risk also to be taken into consideration in ICAP process. In the ICAP process, we give a special type of position to operational risk. The matter here is, it is very difficult for us to quantify operational risk. The quantification is the most difficult task. But however, we need to do quantification by defining KRIs, doing RCSA and so on and so forth. We need to quantify it to a greater extent. Now that quantification is necessary to give an assessment of operational risk capital for this ICAP process. I think your question is a valid question, because ICAP process tries to see the adequacy of capital. Or internally, how you check that. That is the process of ICAP. And ICAP very critically look at the risk which are not coming under credit market or operation, some other risk. Those are also being taken into consideration and quantified under the ICAP. But operational risk quantification is it's a main level of thing which we cannot really just omit in the ICAP process. Your query is answered properly, or you need something
Yes,
else?
sir, thank you.
Now, I don't know whether your branches or your banks, whatever, do you have a KRI process? Because I think in most of the banks, they have a risk dashboard. In risk dashboards, they just put the KRIs and get an idea. Every week or every month, they get an idea about their risk profiles by looking at their KRIs. Right. Anything else you need to clarify? Right, I think we have to now wind up the session today for the time being. And next session, I will come up with several other details about these things, and then I expect to give you a session on cyber risk also, because those are the latest type of things in operational risk management, because that is also coming under operational risk, because it really deals with the technology. Right. With that, I wind up the session today. Thank you very much for all of your active participation. And I expect all of you to participate actively in this and just talk, just discuss. As Thirukumar said, that you need to have some type of discussions or whatever, the groups or whatever. That's a very good idea. So I think, so you all can get together and do this discussions, and you might enlighten yourself with that. If you need any type of resources, any type of additional documents or whatever, I will try my best to do that. Right. Okay. Thank you very much for your participation, and we will do better things in time to come. Then we will meet again on next week. Thank you.
Sir, can we get the past papers to the past years?
Yeah. We will. I will give you.
Yes, sir, please.
Right.